A Morningstar strategist just told millions of dividend investors they are about to get burned. $22 billion chased dividend ETFs last quarter, and Wall Street called it a peak. Then, in a single week, while everyone was reading the warning, $711 million walked into SCHD. The same week, $3.27 billion walked out of QQQ. That is not a peak, that is a rotation. And in the next 13 minutes, I am going to show you 3 reasons the dividend ETF warning may be directionally right and still miss the most important part of the story. Here is what happened. On May 20th, 2026, a Morningstar Indexes strategist named Dan Lefkowitz published a piece arguing that the wave of money pouring into dividend ETFs this year is a contrarian sell signal. His exact line was that interest in dividend stocks seems less about income and more about playing defense in equities. His warning was that it is best to be invested in dividend stocks before you need defense, not after. And he has data on his side. 5 years of global dividend ETF flow history, a pattern showing that crowded defensive buying tends to appear near turning points, not before them. Quick disclaimer. I am not a financial advisor, and this is not financial advice. Always do your own research before making any investment decision. What I am about to share is a framework, not a prediction. Lefkowitz is using the 2022 comparison as his anchor. More than $50 billion flowed into dividend ETFs in the first half of 2022. Then dividend stocks came in just in time to lag through 2023 and 2024. So if you saw the warning last week and your stomach turned over, I understand. The data sounds airtight. $22 billion inflow wave. Strongest quarter since 2022. Historical pattern says lag is coming. But here is the question I want you to hold on to. Is 2026 the same regime as 2022? Because if the answer is no, the warning is right about behavior and wrong about consequence. And that distinction is worth thousands of dollars to anyone holding SCHD, DGRO, VIG, or VYM right now. So let me walk you through the framework I use whenever a credentialed analyst issues a contrarian warning. I call it the 3-layer lens. Layer 1 asks if the regime is the same. Layer 2 asks if the cohort is behaving the same way. Layer 3 asks if the warning even applies to my portfolio role. Run any warning through those 3 layers, and you get an answer the headline cannot give you. Layer 1. Regime. In 2022, the Federal Reserve was hiking rates by 75 basis points at a clip. Growth stocks were getting demolished. The Nasdaq lost roughly a third of its value. Dividend ETFs looked great by comparison because everything else was on fire. That was a defensive crowd hiding from a growth crash. In 2026, the Fed held rates steady on April 29th with the highest level of internal dissent we have seen in years. That is a higher for longer environment with uncertainty. It is not a growth crash, it is a selective rotation. The capital that left QQQ on May 5th did not just disappear. About $1.48 billion of it landed in VOO the same day. Another $711 million landed in SCHD that week. This is money moving inside equities, not fleeing them. Why does that matter for your dividend ETFs? Because dividend ETFs do not need a panic to work. They need cash flow to keep paying. When the regime is rate cut paused, dividend growers like SCHD, DGRO, VIG, and VYM are not just playing defense. They are doing exactly what they were designed to do, which is to distribute earnings from companies with durable balance sheets. The Lefkowitz warning frames this as crowded defense, but crowded defense in 2022 looked like investors fleeing a fire. Crowded defense in 2026 looks like investors choosing income over growth. Those are not the same trade. And the rate backdrop is doing something subtle here that the headline misses. In 2022, the rate shock was new. Investors had not yet learned how dividend growth funds would behave under a sustained tightening cycle. By 2026, that learning has happened. Investors have seen SCHD continue raising distributions through a hostile environment. They have seen DGRO keep compounding its payout. They have seen VIG hold up during the worst growth drawdowns since the financial crisis. That is not the same psychological cohort that piled in 3 years ago. It is a more battle-tested, more selective, and more income-focused buyer. Layer 2. Cohort behavior. The Lefkowitz piece says inflows are crowded. The live flow data from the same week says something more specific. SCHD pulled in $711 million in a multi-month high. QQQ lost $3.269 billion in a single day on May 5th. VUO pulled in $1.48 billion the same day. So capital is rotating from concentrated growth into a basket that includes both broad market exposure and dividend growth quality. That is not the behavior of a frightened crowd. That is the behavior of investors rebalancing toward cash flow. And there is one more piece. In 2022, dividend ETF inflows were a hot money trade. In 2026, the ecosystem is different. SCHD alone holds roughly $95 billion in assets. VIG holds roughly $102 billion. VYM holds roughly $65 billion. DGRO holds roughly $37 billion. These funds are now embedded in target date portfolios, retirement plans, and advisor model portfolios. The money inside them is stickier than the speculative defensive money that surged in early 2022 and then exited the moment growth came back. Sticky money does not crash out the same way. It also helps to remember what is actually inside these funds. SCHD is not a junk yield basket. It holds names like Texas Instruments, Qualcomm, United Health, Chevron, Coca-Cola, ConocoPhillips, Merck, Verizon, Pepsi, and Procter & Gamble. That is a portfolio of cash flow machines. Consumer defensive, healthcare, energy, financial services, a reasonable slug of technology too. When Lefkowitz says crowded defense, he is technically right that the sector mix tilts defensive. But the underlying earnings power inside these names is the kind of free cash flow that funds buybacks and dividend hikes, regardless of which way the broader market drifts. That is a very different thing from speculative defensive cash hiding in a single sector. Consider Harry. He holds a $100,000 SCHD position he bought during the 2022 drawdown. He watched it lag the S&P 500 for 2 years. He did not sell. By May 2026, his position could potentially have rebuilt to a 1-year total return that meaningfully outpaces what panic sellers locked in, if historical averages hold. The point is not that he was a genius. The point is that he was not playing the same game as the people Lefkowitz is warning. He was not chasing a defensive trade. He was building a dividend growth allocation. And that brings us to the third layer, which is where this entire conversation actually lives. Layer 3. Portfolio role. This is the part Wall Street keeps getting wrong, and it is the most important point in this whole video. The Morningstar warning measures dividend ETF performance against the S&P 500. Relative performance. The argument is that dividend ETFs may underperform SPY going forward. That may be true. It may not be. But here is the question Lefkowitz is not asking. Underperform relative to what goal? Because if your goal is to beat SPY, then yes, a 2 to 4 percentage point lag matters. But the people loading into SCHD, DGRO, VIG, and VYM are not benchmark chasers. They are income builders. And income builders care about 3 numbers the relative performance frame cannot see: yield, dividend growth rate, and drawdown durability. A relative performance hit can be brutal on a chart and still be irrelevant to your retirement plan, because the dividend keeps landing in your account regardless of whether the benchmark stretches further ahead in any given 12-month window. That is the part the warning headline cannot capture, and the part most retail investors never get explained to them. Let me show you what those 3 numbers look like across the lineup. SCHD currently runs about a 3.2 to 3.3% yield with a 0.06% expense ratio. DGRO runs about a 2.2 to 2.5% yield with a 0.08% expense ratio and a 5-year dividend growth rate near 9 to 10%. VIG runs about a 1.7 to 2% yield with one of the lowest expense ratios in the category and a 5-year dividend growth rate near 9.4%. VYM runs about a 2.7 to 3.1% yield with a 5-year dividend growth rate near 6 to 7%. None of these funds were built to beat SPY. They were built to compound cash flow, and cash flow does not stop just because the benchmark runs hot for a year. Here is the insight I built this entire video around. The Lefkowitz warning is correct, that the timing of dividend inflows often coincides with relative underperformance. He is right. The data is real. But he is making a tactical claim, and most of the audience reading the warning is making a strategic decision. Tactically, he may be telling traders to wait. Strategically, he is telling income builders to second-guess a structural allocation. And that is where the framing breaks. Now think about what selling actually costs. If Harry had sold his $100,000 SCHD position the day after the Morningstar piece dropped, he would have given up roughly $3,200 to $3,300 of annual income at current yield. He would have missed the next quarterly distribution. And if he tried to time the re-entry 6 months later at a higher price, he could potentially buy back fewer shares. The opportunity cost is not just the lag. It is the income stream he interrupted, the compounding he reset, and the reinvestment shares he did not buy. That is why the live flow data tells a more useful story than the warning. The $711 million weekly inflow into SCHD is not the sound of a crowded crash trade. It is the sound of investors saying, we are not playing the S&P chase. We are playing the cash flow game. Now, I want to be fair to Lefkowitz. He is not wrong that the macro income case has weakened. The Morningstar US Core Bond Index yields around 4.5%. The Morningstar US High Dividend Yield Index yields around 2.3%. On pure yield, bonds win, so the pure income argument for dividend equities has gotten harder. But pure yield is layer 3 reasoning. Dividend growth, qualified tax treatment, and equity upside are layer 1 and layer 2 reasoning. The full picture still favors a dividend growth allocation for investors who care about long-term cash flow rather than current yield only. So here is how I would think about it if I were sitting where you are sitting. If you are a trader trying to time the next 12 months of relative performance, Lefkowitz may have given you a useful signal. Trim if you must. If you are an income builder with a 5 to 20-year horizon, the warning describes someone else's trade. The flow data says you are not late. The ecosystem says you are early to a structural reallocation. Harry would let the next quarterly distribution come in, reinvest it, and look at the position again in 12 months when there is actual data instead of a Morningstar headline. The one trap to avoid is reading a relative performance warning as a strategic verdict. That is what burns income investors every cycle. It is not the warning that costs them money. It is the panic decision that follows. Every time a credentialed analyst publishes a sober contrarian piece, a portion of the audience reads it as a sell signal, regardless of whether their own portfolio role even maps to the warning's frame. And that is the exact behavior that has historically transferred